Welcome everyone to the Imperium Forex educational webinar. My name is Rob Clayton. In today's session, I shall be talking about leverage. Before we begin, I would like to make a note that any advice is of a general nature only and that your personal circumstances have not been taken into consideration. What is leverage? Leverage allows a trader to manage a larger position in what they have as equity in their trading account. Leverage is most commonly used in real estate transactions through the use of mortgages to purchase a property. For instance, if you want to purchase a property that's worth $500,000, you would need 10% capital that's required to purchase this property. But you only have $50,000. So how are you able to purchase this house that is $500,000 because you only have 10% of the current deposit? So you visit the bank and borrow the remaining 90% in order to purchase this property. What you have done is use the bank as leverage with your $50,000 deposit in order to control a $500,000 purchase. The same leverage principles apply in trading Forex. Here is another example. When most people think about investing, you often think you may need a large amount of initial capital in order to deposit to start trading. Forex is much more accessible due to the usage of leverage. So how can leverage affect your use of trading? You may be interested in buying a property that's on the market for $100,000. Visiting your local bank manager, you express your interest of taking out a loan or mortgage. The bank manager requests that you deposit 20% of the property's price as a down payment on your loan. So for $20,000, you are now able to enter in an ownership of a $100,000 apartment. This is a representation of leverage in real estate. You have purchased this property at a leverage of 5-to-1, since $20,000 is 1/5 of $100,000. 1 year later, the property market has gained by 50%. So you decide to put the apartment back on the market to sell for an asking price of $150,000. You sell your property for $150,000. Therefore, you would have gained a profit of $50,000. If you had not taken out a bank loan and only used your $20,000 to buy a smaller property, which cost the amount you deposited, your total profit after selling would only have gained you $10,000. This is by using a leverage of 1-to-1. Using a 5-by-1 leverage, it allows you to earn 5 times more than you would have if you had traded without leverage. So the amount would have been $50,000 in the rising house price. Where if you used a 1-by-1 leverage, you can see you would have only made $10,000. So let's see how we can apply leverage to foreign exchange trading. You currently have 1,000 euros to invest in the market. So you decided to enter a trade by buying 100,000 euros worth of euro US dollar at a rate of 1.0630. Since 1,000 is 100 of 100,000 euro, you can use a leverage of 100-to-1. Then the euro rate rises from 106.30 to 106.40 and you decide to exit the trade. By that, you have made 10 pip profit. Therefore, you will see that you have gained $100 profit. If you had not traded with leverage, then you would have only gained a profit of $1. Depending on your account type or investment and risk preference, you can trade much smaller or larger size deals and different levels of leverage. It is important that you are aware of by trading higher leverage, you can increase your potential profits, but it can also lead to bigger potential losses too. Due to this risk, Imperium Forex encourages you to plan your trades and by developing to a good risk management strategy and learn and continue to learn more about trading and understanding the markets further. So let's take a look at another example. Using the euro against the US dollar, if you want to buy 10,000 lots of the euro against the US dollar, you would need $100 margin in your account to be able to place the trade. Using the leverage of 100 to 1, in simple terms, you can trade 100 times what you have deposited. Therefore, for every $1 US you have, you can trade $100 US with a leverage of 100 to 1. Furthermore, if you deposit $1,000 into your account and you want to trade any currency pair with $1 per pip, you would need a minimum of $100 in your account as a margin to be able to trade. So let's look a little bit more deeper into this. Understanding leverage. Leverage ratio and the minimum margin requirements. So if you maintain a minimum 2% margin in your account, this means that you must have at least 2% of the total value of an intended trade available as cash in your account. Expressed as ratio, 2% margin is equivalent to 50 to 1 leverage ratio. So 1 divided by 50 equals 0.02 or 2%. Leverage ratio and minimum margin requirements. The comparison of leverage ratio and the minimum margin requirements expressed as a percentage. So, looking at the left-hand side, if the leverage ratio is 100 to 1, then the minimum requirement margin is 1%. If it's 50 to 1, the minimum requirement is 2%. And as you can see, as you go down, 40 to 1, 2.5, 30 to 1 is 3.3, and 20 to 1 is 5, and 10 to 1 is 10%. So, when we look at examples like $1 equals $50 and $2 to margin is $100 and $3 is $150, this is where the margin-based trading can be a powerful tool. With as little as $1,000 of margin available in your account, you can trade up to $50,000 at a leverage of 50 to 1. So let's have a look a little bit more in regards to pip trading. So one standard lot when you're trading MT4 is $10 US per pip. When you're using a mini lot, which is 0.1, that is $1 US per pip. And when you're trading 0.01, which is a micro lot, then you're trading 0.10 or 10 cents. So sell or buy, the pip value above gives you an idea of the lot size when you're actually placing a trade. So do take note of that, because sometimes people make a mistake and actually put one lot on, which as you can see, if you do apply that trade, every pip value will be worth $10 US in a loss or winning trade. So let's have another look at the lot value. So when you're trading one standard lot, it's equivalent to 100,000 units of base currency. When you're trading one mini lot, which is 0.1, then you're trading 10,000 units of a base currency. When you're trading a micro lot, that is 0.01, which is 1,000 units of base currency. So, if one micro lot, 0.01 of the Euro US, each pip value will be worth 10 cents. As opposed, if you're trading one standard lot, the pip value is $10. Here is a short list of traded symbols and their pip values. On the left, FX pairs, you can see that the Australian dollar against the US, one standard lot is $10 US per pip. And as I mentioned before, a mini lot is $1 US and a micro lot is 10 cents. This goes for euro, sterling, gold. However, the US dollar against the Japanese yen, one standard lot is 1,000 yen. A mini lot is 100 yen and a micro lot is 10 yen. And take note of the silver. One standard lot is $50 US per pip. So be very careful when trading the silver due to the size of the pip if you are trading one lot. A mini lot for the silver is $5 per pip and a micro lot is 0.5. So do be very careful when trading these markets that you understand the lot value when it comes to one standard lot, to a mini lot, to a micro lot. Looking at the MT4, this is what the symbols and what the sell and buy, and also in the middle you can see here is one lot. So looking at the top left, you can see the euro trading at 105.8894. Now to trade the left side of one lot, as I mentioned before, is $10 a pip. So that pip will be a micro pip there. So at 105.882 is the actual pip that you're looking at. So when trading, get a little bit familiar of the sizes of the one standard to a mini and micro. So this brings an end to my webinar. Thank you very much for joining me. I hope you find this presentation useful to your trading. So from myself and Imperium Forex, would like to thank you for your attention and joining me to this educational webinar.